Imagine for a second that you've done everything right. I mean, you followed the playbook, you worked hard, you didn't buy the flashy sports car, you lived below your means, and you stashed your savings in a nice, safe savings account.
Right.
You sleep soundly knowing that money is there. It's your safety net. But what if I told you that keeping that money safe might actually be the most dangerous financial decision you could possibly make right now?
It sounds completely backwards, doesn't it?
It does.
We are raised on this idea that savings equals safety. It's just ingrained in us.
That's the first rule of personal finance.
But when you look at the macroeconomic data specifically regarding the cycle we are entering in 2026, the definition of safety has, well, it's fundamentally shifted. In fact, safety has become risk.
That is a terrifying opener. But look, today we are unpacking a really heavy, but honestly, incredibly necessary deep dive.
Yeah.
We're looking at a breakdown of economic cycles based on the Dalio Explained video titled Ray Dalio. Having idle money in 2026 will ruin you. Do this now. And the mission today is pretty straightforward. We need to understand why 2026 is being flagged as this critical tipping point, why the source claims money is actually an illusion, which sounds like something a magician would say, and most importantly, the specific steps suggested to stop our wealth from disappearing into thin air.
And just to set the stage here, because I don't want people to think we're reading tea leaves.
Right.
The source material emphasizes that this isn't some crystal ball prediction. It's not magic. It is described as a logical consequence of historical economic cycles. These patterns have repeated for centuries long before we were born, and we are simply arriving at a very specific, very volatile part of that cycle.
Okay, let's unpack this idea that money is an illusion. Because I look at my bank account app, and those numbers look pretty real to me. If I have a dollar, I have a dollar. It buys me a candy bar.
Well, barely.
Well, actually, barely a candy bar these days, but you get my point.
Philosophically, yes, you have a unit of currency. But practically, no. The source makes a really compelling comparison here. If you had taken $100,000 in 1980, which was a fortune back then, and put it under your mattress, today you lift up the mattress, and you still have $100,000 in paper.
Right.
But in terms of what you can actually buy with it, that money has the purchasing power equivalent to just $30,000 today.
Wow. So nearly 70% of the value just evaporated.
It's gone.
It's like ice melting.
It didn't disappear. It was eroded. This is the cycle of monetary debasement. It's a mechanism governments use during crises, wars, pandemics, depressions. When the going gets tough, the government prints money.
Always.
It happened in the Great Depression, World War II, 2008, and most recently, the pandemic.
And that last one was a big one, right?
Yeah.
I think I saw a statistic in the notes that actually made my brain glitch.
It is a staggering statistic. Between 2020 and 2022, the United States printed more money than in its entire previous history combined.
Okay, I need to stop you there because that sounds fake. You're saying in roughly 24 months, we printed more cash than we did during the Revolution, the Civil War, 2 world wars, and the entire Industrial Revolution combined.
It sounds impossible, but it's the math. Think of it like this. Imagine you have a bathtub representing the U.S. economy.
Oh, hey.
For 2 centuries, we've been adding water with a garden hose. Steady, manageable.
Right.
Then, in 2020, we backed up a fire truck and just blasted the tub.
Yeah.
The tub is the same size. That's the goods and services we produce, but now it's overflowing with water. That water has to go somewhere.
And that somewhere is higher prices.
Right. But it's not just inflation, like milk costing a dime more. It's a fundamental dilution of the currency. Every dollar in your savings account just got watered down because there are suddenly trillions more of them floating around.
Right.
The source uses this great analogy of the economy as a giant clock with gears, productivity, credit, inflation. Usually they turn in harmony. But recently, we artificially accelerated specific gears via stimulus and zero interest rates.
Basically redlined the engine.
We supercharged the consumption gear and the credit gear. And now we are facing the moment of adjustment. The rule of this adjustment phase is brutal but simple. Real assets preserve value. Paper money loses it.
So when you say real assets, you mean things you can touch.
Things that have fundamental utility. Productive companies, real estate, commodities. Paper money, on the other hand, cash, low-yield bonds, is what gets crushed. And this leads us to a concept called the Cantillon Effect.
The Cantillon Effect. Sounds like a Robert Ludlum novel.
It's actually 18th century economics, named after Richard Canton. It explains how inflation actually moves through a society. People tend to think that when the government prints money, it magically sprinkles evenly over everyone at the same time.
Yeah, like a gentle rain.
Right, a helicopter drop, everyone gets a bag of cash.
Exactly.
But that's not how it works. The new money enters the system through specific entry points, usually the banking system and financial markets first.
So the people closest to the spigot get wet first.
Precisely. The winners in this scenario are the banks, corporations, and institutional investors. They get this fresh money and use it to buy assets, houses, stocks, commodities before prices rise.
Okay, hold on. That sounds like a rigged game.
Wow.
You're telling me the system is designed so that by the time the money hits my direct deposit or my salary, it's already worth less than when the bank got it.
It feels rigged, doesn't it? Think of honey being poured onto a saucer. It piles up in the middle first. That's the banks and the wealthy asset owners. It takes time to spread to the edges. That's you, me, the salaried worker, the retiree.
So the people in the middle are licking the spoon and we're waiting for the drip.
That is a visceral but accurate way to put it. The losers are the ones furthest from the source. By the time the money circulates down to them, prices for everything have already gone up.
Wow.
So if you are sitting on idle cash, you are effectively donating your purchasing power to the people who bought the assets early.
That makes me mildly furious. But it explains why the gap between the rich and the poor seems to explode during these times.
It does.
You're waiting for your salary to catch up, but the asset prices have already left the station.
That's the mechanics of it. And this brings us to why the source pinpoints 2026. It's not an arbitrary date picked out of a hat. It's when the consequences of that massive printing we discussed earlier become impossible to ignore because of 4 specific incentives.
The perfect storm, as the source calls it. I want to walk through these slowly because this is the why behind the urgency. Incentive number 1 is the national debt.
The big number. The U.S. debt has surpassed $33 trillion. But the scary part isn't just the total, it's the interest.
Right.
The annual interest payments on that debt are now acting as a $1 trillion line item in the budget.
Just to pay the interest. That's money that isn't building bridges or schools or hospitals.
Correct. It is dead money. And here's where we get into what economists call a fiscal dominance trap, or a doom loop. The government owes $33 trillion. Interest rates went up, so paying the credit card bill became more expensive. They don't have the tax revenue to pay it, so how do they pay that $1 trillion?
You'd put it on another credit card.
Essentially, they have to borrow more to pay the interest on what they already borrowed.
It's like using a Visa to pay off a MasterCard.
Yeah.
Eventually, the bank cuts you off.
Exactly. But here's the kicker. To borrow that money, they issue bonds. But who buys them?
Good question.
If nobody wants them because they're worried about the U.S. debt, the Federal Reserve steps in and buys them. And how does the Fed pay for them? They print the money.
Of course.
Printing causes inflation, which drives interest rates up, which makes the debt even more expensive to service.
It's a snake eating its own tail.
A very expensive snake. And that's just the first pressure point. Incentive number 2 is demographics.
The silver tsunami.
It is a mathematical certainty. 10,000 Americans turn 65 every single day.
Wow.
And that is going to continue for the next 15 years.
That's a lot of retirement parties.
It is. But financially, it means mandatory spending for Medicare and Social Security is exploding. This spending happens automatically. It doesn't matter who is in the White House or Congress. The bill comes due every month.
Right. And then you add incentive number 3, geopolitics.
We are in an era of great power competition, specifically with China and Russia. That necessitates high spending on military and infrastructure. Again, this is bipartisan. Whether it's defense or national security, the spending is considered non-negotiable. You can't austerity your way out of a geopolitical conflict.
And finally, the 4th incentive, which I think flies under the radar for a lot of people, the banking crisis.
This is the silent crisis. Regional banks are sitting on massive losses in their bond portfolios.
Can we pause on that? Why does raising interest rates break the banks? I thought banks liked high interest rates.
Great question. Here's the trap. When rates were 0, banks took your deposits and bought safe government bonds paying like 1%.
Okay.
They plan to hold them for 10 years.
Okay. Seems safe enough. Government bonds are the gold standard.
Usually.
Yeah.
But then rates shot up to 5%. Now there are new bonds available paying 5%. Nobody wants the old 1% bond anymore unless you sell it at a massive discount. It's like buying a brand new iPhone for $1,000 and the next day a better one comes out for the same price. Your old iPhone just lost half its value instantly.
So the banks are holding billions of dollars of old iPhones.
Billions. And if we all go to withdraw our cash at once, They have to sell those old iPhones at a loss to pay us. That's how you get a bank collapse.
Right.
And to prevent that, the government will likely have to intervene, essentially print money, to make the banks whole.
So debt, demographics, geopolitics, and banks. All four of these incentives point in one direction. The money printer has to go brr.
That's the conclusion the source draws. If the supply of money is increasing that rapidly, the value of the cash in your pocket must decrease.
To really drive this home, let's talk about the Martinez family versus the Thompson family.
Yes.
Because I read this in the notes, and honestly, I felt bad for the Martinez family. They did everything right.
They really did. They were the model citizens. 1970 Chicago. They saved $50,000. They put it in the bank. They earned interest. They weren't gambling on the ponies. They were being prudent.
And they got crushed for it.
Decimated. By 1980, on paper, they had $81,000.
Yep.
They gained 62% in raw dollars. But inflation over that decade was 112%.
So they had more dollars, but they could buy less than half the stuff they could in 1970.
They saved religiously and became poorer. That is the tragedy of the safe route during high inflation.
Meanwhile, their neighbors, the Thompsons,
The Thompsons didn't trust the bank. Or maybe they just saw the writing on the wall. They diversified, they put their money into stocks, real estate, and metals. By 1980, their assets had grown to $195,000. They didn't just preserve their wealth, they tripled it in real terms.
it's like running on a treadmill.
Right.
The Martinez family was running hard, but the treadmill was moving faster than them. The Thompsons just got off the treadmill.
Exactly. The source also mentions the Weimar Republic, the wheelbarrows of cash for bread example, which is obviously the extreme version.
Right.
We aren't predicting the US dollar becomes worthless confetti, but the mechanism of wealth transfer is identical.
So let's look at the math of doing nothing right now, because I think a lot of listeners might be thinking, well, 3 or 4% inflation isn't that bad. I can live with that.
It's silent destruction. If you have $100,000 sitting idle, and we accept the official inflation rate of 3–4%, though real inflation often feels much higher at the grocery store,
Right.
you are losing $3,000 to $4,000 of purchasing power every single year.
It's like a subscription fee for holding cash.
A mandatory subscription.
Yeah.
And if inflation ticks up, if we hit 6–8%, which is entirely possible given those four incentives we discussed, you're losing $6,000 to $8,000 annually.
Let's apply that to retirement. This is where it gets scary.
Imagine a retiree with a $1 million nest egg. They think they are set for life. If we see 6% inflation for just 5 years, that $1 million is effectively worth only $750,000. You've lost a quarter of your retirement lifestyle without spending a dime.
Wow.
That's one less vacation a year, or downgrading your care facility later in life.
And for younger people.
The time horizon makes it worse. A 35-year-old keeping $50,000 in cash for 30 years at just 4% inflation. That money shrinks to less than $15,000 in value. It's devastating.
Okay, we've thoroughly terrified everyone. I'm sweating a little bit. Let's pivot to the solution.
Good idea.
The source outlines a specific strategy called the Inflation Protection Portfolio. The goal here is to get out of the broken basket of paper money.
Right. And remember, this is about asset allocation. The source suggests a breakdown to weather the storm. The biggest chunk, 40–50%, goes into stocks.
But not just any stocks. You can't just buy a random index fund and pray.
No, the source is specific.
Yeah.
You need companies with pricing power.
Define that for me. Is that just a luxury brand?
Not necessarily. It's a company that can raise its prices when inflation hits, and you have to pay it.
Oh.
Think about your toothpaste or the software subscription that runs your business. If they raise the price 10%, you might grumble, but you pay it because switching is too hard or you need the product.
Versus a company selling, say, generic T-shirts.
Right. If the t-shirt company raises prices, you just buy a different brand. In an inflationary world, you want to own the companies that can pass the hot potato of inflation on to the customer.
All right.
If they can't, inflation eats their profits and their stock tanks.
Okay, so 40–50% in pricing power stocks. What's next?
20–30% in real estate. This could be direct property ownership or REITs, real estate investment trusts.
Right.
Real estate is a classic inflation hedge because rents typically rise with inflation. As the dollar gets weaker, the tangible asset gets more expensive in dollar terms.
Makes sense. Then we have the hard assets.
10–15% in commodities and precious metals, like gold. These have historically held value when currencies wobble. Gold is basically the anti-dollar.
And bonds. Usually bonds are bad in inflation,
Yeah.
right, like we talked about with the banks.
Traditional bonds are bad. They are fixed income. If inflation goes up, your fixed income buys less. But the source recommends 5–10% in inflation index bonds, like TIP-PS in the U.S.
Okay.
These are designed to adjust their principal value as inflation rises.
And finally, cash. The thing we've been bashing this whole time.
You still need some, but keep it to 10–15%, just enough for emergencies and to pounce on opportunities. You need some liquidity, but you don't want it to be the bulk of your holding.
Now, regarding implementation, the source is very specific here. Do not go home and sell everything tomorrow morning.
Exactly. Panic is not a strategy. The advice is to move gradually. Shift maybe 25% of your portfolio per month over a period of 6 to 12 months.
Okay.
This smooths out your entry price. You don't want to dump everything into gold on the day gold hits an all-time high.
And rebalancing. This is a term I hear a lot, but what does it actually mean in this context?
It's a discipline thing. It means every 6 months, you look at your pie chart. If your stocks went up a lot and now make up 60% of your portfolio instead of 50%, you sell some stocks and buy more of whatever went down, say gold or real estate.
So it forces you to buy low and sell high automatically.
Precisely. It takes the emotion out of it.
And the source emphasizes not waiting. Don't wait for the market to drop. Don't wait for inflation to cool.
Because waiting has a daily cost. Every day you sit in cash, the termites of inflation are chewing on the foundation.
What I appreciate about this source is the flexibility. They talk about scenario planning. Because we don't know exactly what the future holds, just the direction.
Right. If we have moderate inflation, 4 to 6%, this diversified portfolio works well. If we hit high inflation, 7 and 10%, the commodities and real estate parts of the portfolio do the heavy lifting.
And then there's the nightmare scenario. Stagflation, low growth, high inflation.
That's the 1970s again. In that case, utilities, REITs, and gold become your lifeboats. But the key is to avoid highly indebted companies and fixed income that isn't inflation protected. Those are the anchors that will drag you down.
It really comes down to a philosophical choice, doesn't it? The source frames it as a trade-off between costs.
Every choice has a cost. The cost of investing is volatility. It's loud, it's scary, the market goes up and down, and it makes headlines.
Right.
But it's usually temporary. The cost of idle money is inflation. It's silent, it's certain, and it's permanent.
That's a powerful way to put it. You have to choose your pain. Do you want the headache of volatility or the cancer of inflation?
For most people, especially those looking at a 5 to 10-year horizon, the cost of inflation is far more dangerous than the cost of market swings. The biggest risk in 2026 isn't that the stock market might dip, it's the complacency of thinking your bank account is safe.
It's a massive wake-up call. We are staring down a wealth transfer. Money is moving from those who hold paper to those who hold assets.
And history is impartial. It doesn't care if you are a nice person, a hard worker, or if you volunteer on weekends. It only cares about how you are positioned.
So as we wrap up this deep dive, the question we want to leave you with is this. In the coming wealth transfer of 2026, will you be a student of history or a victim of it?
The choice and the action required is entirely up to you.
Thanks for listening to The Deep Dive. We'll catch you on the next one.